joining for this session run by First Intuition. We are going to have a look at a business tax question. We're dealing with Finance Act 2023 and today is going to be about capital allowances, and this is task 2 from our revision material. So let's remind ourselves what's in the reference material in relation to capital allowances. Here it is in section 5, split into 2 parts. We've got the capital allowances on assets other than cars, and then we've got cars. So I will be referring to this as I go along, making sure that I'm applying the right percentages to the right assets. Notice that there is this little section here on full expensing. Full expensing is relatively new to the syllabus, but it only applies to expenditure by companies. It only applies to expenditure on new assets, so it can't apply to second-hand ones, and the expenditure has to take place after 1st of April 2023. When it does get tested, usually there is a choice of whether you want to claim the normal AIA or you can claim the full expensing. So you don't have to do both, of course, you choose one or the other. So the benefit of full expensing is that if you do spend more than £1 million in the period, then there is no upper limit on your expenditure. So that's one of the main advantages of that one. Okay, so let's just bear that in mind as we make our way through this question, and yeah, we'll get to the question now. Here we are, task 2. So task 2, as I said, is about capital allowances. This task in the assessment is going to be 12 marks, giving you about 14 minutes to get it finished. Our task briefing here sets out some of the key features of capital allowances that you ought to be aware of. If you feel confident with them, you may want to go with me now straight to the question. If you feel you're a little bit weaker in terms of capital allowances, you may want to pause the recording, have a quick read through the task briefing, just to remind yourself of some of the key facts of this area. A few things particularly to watch out for, but we'll get to them as we go through the example. I will maybe just highlight a couple which I think are particularly important. No private adjustment for assets for companies. So where you might have private use of an asset by a sole trader or even a partnership, a company cannot use an asset itself, so there's no private use. Companies can't have a period of more than 12 months for capital allowances. So if they have a long period, we have to split that into 2 calculations, the first 12 months and then the rest. And as we've just said, companies can claim full expensing for expenditure after 1st of April 2023. If we have a short accounting period, a period that is less than 12 months, we have to time apportion the AIA and the WDA. We don't time apportion anything else. We don't time apportion the full expensing. We just time apportion the AIA and the writing down allowance. There are different rates for cars, which we've just seen in the reference material. And then final point I'm going to mention, if the business ceases in trade, it doesn't claim any of these, doesn't claim the FYA, the AIA or the writing down allowance. Instead, what happens is we treat everything as being disposed of and there's a balancing allowance or a balancing charge to clear everything out. So I don't usually run through the task briefing, but I do think for capital allowances there's so much going on and it's quite a big question, better to be a little bit more prepared. But feel free to spend a few more minutes reviewing that task briefing if you want before we get going with the example. You can just pause the lecture and come back to it later. So here's an example tax that we're going to practice then. It's Ferguson Limited. So that's my first little pop-up alarm in my head. I'm dealing with a company. And Ferguson Limited has the following non-current asset information. And I've got another little pop-up in my head now because it's an 8-month period. So it's a company and it's an 8-month period. And I've just talked about how I'm going to need to time apportion the writing down allowance and the annual investment allowance. We talked about it here. So they're going to need to be time apportioned. We don't time apportion the FYA, but we do time apportion writing down allowance and the AIA. Ferguson Limited, so that means there's no private use of assets. It also means that there may be assets that qualify for full expensing. So it's something else to think about. So here are my balances at the 1st of December 2022. And here are the various additions during the period. Let's just skip on and see what else we know. Due to trading difficulties, the company then ceases on the 29th of February 2024. Here are the sale proceeds of everything. So there's actually a couple of different computations needed here then, because the first one is going to take me this short 8-month period up to July of 2023. And then after that, I'm going to prepare another computation to take me from the 1st of August 23 until all the assets are sold on in February of 2024. So 2 computations are going to be needed. So I just need to make sure I take everything step by step. So where would I start? I'd always start by familiarising myself with the pro forma that I've been given. So you can see that I've got space here for some narrative, some details of what's happening over here. Then I want to label some of my columns. And I would always start with AIA and then FYA. I'd always have allowances right at the very end. But because I don't exactly know what I need yet, I'm going to have a look through the question, then decide what I'm going to put into these headings. I know allowances come at the end, so I can fill that in. And I know that my narrative comes over at the beginning. But what about the other 3 columns? What will go in there? Let's have a look. Well, a bit of help here. I've got a general pool, so I'm going to need a general pool column. I've got a special rate pool, so I need a special rate pool column. I also have some additions during the period. Let's see when they took place. 11th of December 2022. So I'm going to say here that would qualify for AIA. Delivery van, 20th of March 2023. That will also qualify for AIA. What about full expensing, you might ask? Well, often in questions, you might have the choice of AIA or full expensing, assuming your assets are new. But full expensing is for expenditure by companies after 1st of April 2023. So here, full expensing doesn't apply. So full expensing is not applicable because everything is spent before 1st of April. So that's why. Okay, next one. We have the purchase of a car for our sales manager. It has some private use, completely irrelevant for companies. Private use by an employee is not private use anyway. It has to be by the owner of the company or the owner of the business. And of course, for a company can't use the car itself, so there's no private use. So what am I going to get in terms of a sales manager's car with emissions of 30 grams per kilometre? I need to check the reference material section on cars. So it's not 0 emissions, so I can rule out that first one. But it is in here. Up to 50 grams per kilometre, 18%, which puts it into the general pool. And just as a reminder, if it goes into the electric car column, 0 grams per kilometre, that would claim FYA. And if we're looking at emissions over 50 grams per kilometre with 6%, that would go to a special rate pool. So mine, 18%, bang in the middle. It just gets lumped in with everything else in my general pool. So that's helpful to know. And I now know the headings I'm going to need. AIA, general pool, and the special rate pool. AIA and FYA would always come first. And then in terms of general pool and special pool, there's actually no reason that they need to go in any particular order. So you can choose for those. Once the column headings are all organised, then we're going to start with our first figure being the balance brought forward. We're given that in the question, and that will be followed by the additions. And I've got 3 different additions, so I'm going to list them. I've got some plant and machinery, there's a van, and there was a car. So they would just need sufficient detail to identify which ones they are. Let me start with the balance brought forward. From the question here, just a case of entering those into its respective columns. So I've got a balance on the general pool and a balance on the special rate pool. And then in terms of the additions, here they are. Plant of 150, van 38.5, car 22.7. We decided where they were going to go. We said the plant and machinery in the van would go into the AIA. And the car would go into the general pool. If I had disposals, I'd need to start thinking about those as well, but there weren't any in this first period. So what would I do next then? I think I'd probably subtotal these now before I think about the allowances. I can then consult the reference material if I need to remind myself what percentage the allowances are. And the first allowance I'm going to consider is the AIA. And the AIA is actually 100%, but it's also a maximum of £1 million for a year. And this set of accounts isn't a year. This set of accounts is 8 months. So even though I've still got lots of allowance left, I want to demonstrate to the marker, remember this is a human marked question, that I knew that there was a restriction and I made sure that we complied with it. So it's a maximum of 666,667. Doesn't really affect us here, does it? Because we're actually only claiming 188,500. But I just wanted to demonstrate I'm aware that I am restricting the AIA. The writing down allowance is also restricted. And the writing down allowance here for the general pool is going to be restricted to 8/12. It's at 18%, but I'm only going to be able to claim 8 months of it. That's how I time apportion this one or restrict it. I find out what the writing down allowance would be for a whole year. And then I say, oh, but you can't have all of that. You can only have 8 months worth. So I restrict it and it comes out at 41961. I do the same with the special rate pool, restricted to 8 months, and the special rate pool gets an allowance of 6%. So I take 6% to start with, and then just scale it down to 8/12. And I'm putting these in brackets to denote that they're being deducted from these individual pools, a little bit like depreciation is, deducted from the carrying value of the asset. And the actual amount claimed gets transferred into my allowances column. Really handy to have that as I go along. So the thing with AIA and FYA is that at the end of the period, the balance on that column should be 0. We never want a balance carried forward on AIA or FYA. No problem to have a balance on the general pool or even the special rate pool, but we don't have balances on AIA and FYA. So I'm not quite finished. I'm just nearly done here, I think. I'm going to finally find my total allowances. And this, just to keep some context, would be the figure that I include in my TTP. When I'm calculating the profit for the company, and I have the trade profit figure before capital allowances, and then we need to know what the capital allowances are, this is where this figure comes in. So it reduces our trade profit figure within the TTP calculation. So it's part of trade profit. So part of the trade profit section. And there we go. That would be our computation for the period up to, well, I'm just going to label one more bit, for the period up to July 2023. So I'm going to label this part here as the tax written down value carried forward at 31st of July 2023. Excellent. But not the end, because the question then went on to say, in the next period, you dispose of everything. So I now need to do the next period. There's not much room left, so I'm hoping that there's not too much to do here. But I would start with the tax written down value brought forward at the 1st of August 2023. So the first thing that I'm going to do is collect together this row of balances and include it here. I would then deal with the disposals I was told about. There were no additions in this period. This is a period up to February where all that happened is the business ceased and the assets were sold. So I bring in the disposals. General pool, special rate pool, delivery van and sales manager's car. Well, the special rate pool, fair enough, goes into its own column. General pool, yep, no worries. Delivery van, well, that also goes into the general pool. And sales manager's car, yep, also into the general pool. They are not held in their own columns. I don't have a separate column for that sales manager's car or the delivery van. I just bought them. The car went into the general pool anyway. The van went into the AIA column, but now that's been emptied out as it is at the end of each year. Any disposals of anything that was initially an AIA comes out of general pool. So I've got the disposal from special rate pool, and then the other disposals, do 90 plus 25 and 17.5 altogether. We then have our balancing adjustment, which may be a balancing allowance. If I've got a few more allowances that I can still claim, and I'm thinking about my special rate pool here, because I've got a value of 75417, dispose of 70, there's still 5417 in that column that hasn't been claimed yet, so that is an allowance. It brings the value on the column down to 0, and I've claimed the remaining value of that column. I've actually got the opposite problem here with my general pool. I wonder if I should have actually put a subtotal in there. It might have helped you a little bit. Let me just squeeze one in. 5417. There we go. So the subtotal for my general pool would be showing that I've got 24785 minus, which means I've actually sold the assets for more than they were worth. Lovely for me, But as far as the tax office is concerned, they've given us too many allowances, so they now want those allowances back. So where they reclaim an allowance from us, we call it a balancing charge. And it's like a minus allowance. And then that should be it. 0 in all 3 of my columns. There is no balance to carry forward. I'd still label it. So tax value to carry forward, 29th of February. And then as before, I'd make a note of my total allowances. Not so nice in this period for the taxpayer, because rather than getting something good from HMRC, they're being told HMRC want to reclaim some of the allowances they've had in the past. So we actually have an overall balancing charge, a minus balancing allowance if you like. And there we have it. So key things to take away from that one, other than the fact it was 2 separate computations. I think remembering the time apportioning, remembering to limit your AIA. We don't time apportion the allowance itself, we just limit the maximum expenditure. Remembering how to deal with a disposal that creates a balancing allowance or a balancing charge, also important. And remembering that there's no private use on a car for companies at all, certainly no private use on a car that belongs to an employee rather than a owner of the business for sole trader situations. But this is a company, so that was that. Okay, so hope you've enjoyed that one. That one's human marked in the assessment, so the clearer you can make it, the better. And yeah, thank you for joining for that session.